Household debt is on rise and savings are at an all-time low. It's a curious case. In fact, household debt as a percentage of gross domestic product, or the GDP, touched a new high of about 40% in October to December period, which is the third quarter of financial year 2024, as per a report by Motilal Oswal. The trend has a bearing on household net financial savings as well, which is the balance between household gross financial savings and financial liabilities. The report suggests that household net financial savings stood at a 47-year low of 5.3% of the GDP in financial year 23, down from 7.3% in financial year 22 and way below the average of 7.6% of GDP between financial year 2012 to financial year 2020. Essentially, people are spending more and taking loan to finance some of these expenses. But within the realm of household debt, it's the unsecured personal loan that have grown the fastest, followed by secured debt, agriculture loan and business loan, according to the analysis. Now, what does this data really mean and how do we read it? To talk about that, joining us is Yuvika Singhal. She's an economist at QuantEco. Also with us is Professor Arun Kumar, who's an economist. With me is R Sridharan, editor international, here in the studio. Shri, I want to begin with you.
Sure.
You know, when we look at this data in its entirety, a lot of people are likely to be worried. It looks like people are saving less, spending more, but there's more to this data than meets the eye.
So, Shweta, yes, unfortunately in India, the data we get is not passed down to individual. I mean, you have loan accounts, which you know the details for. But I think if you look at the aggregate number, 40% like average debt, you know, for Indian household, actually, it's not very worrisome. I think that's comparable to most other, you know, emerging economies and some developed economies also. But I think where you have to make a differentiation is whether this, you know, aggregate increase in debt, is it because of credit widening or is it because of credit deepening? What do I mean by that? Credit widening would mean that there are more people who are now borrowing. So the people who were probably not borrowing earlier are now borrowing money from banks, financial institutions to do whatever that they need to do, like, you know, buy whatever they want to buy. Credit deepening would imply that the same set of consumers are borrowing more. So now, according to at least some data, which is again from Motilal Oswal, 90% of this growth has been due to credit widening and not deepening. So which means that there are newer consumers who come into the fold. So to that extent, Shweta, I think that's a healthy sign at an average level. What would be of interest is to look at the debt servicing ratio of households. We can talk about that once you have views from the other, you know, economies also on this. Maybe we can talk about that in, you know, subsequently.
All right, very, very interesting there. Is it a case of debt deepening or debt widening? I want to bring in Yuvika into this conversation first. Yuvika, good afternoon. Good to have you on the show once again. What do you really understand by debt deepening, debt widening? For the benefit of our viewers, is one more worrisome than the other? Because clearly, we need more people to get more money or to borrow more money from the markets to be a part of the financial systems of this country. Is the current trend to you in any way standing out? Is it something to worry about?
Hi, Shweta. Thank you for having me. I think neither of the two is worrisome, in my opinion, neither the deepening nor the widening. And the simple logic is because India remains a fairly underbanked, underpenetrated economy as far as financial asset savings is concerned. So it's only good that if we are seeing greater financial penetration, whether it's widening or deepening, I think both are welcome. Having said so, I think when we look at data more closely, and, you know, as an economist, we tend to do that more often than not, I think this decline in financial savings that we are seeing, as you rightly said, has been led by the increase in financial liabilities, again, largely a fallout of the growth in bank credit, both secured and unsecured, at a very sharp pace of that we have seen. But we also need to keep in mind that this is just half of the story. When you talk about household balance sheet, it's not just the financial assets and liabilities, but we also have to look at physical side of the balance sheet, which is essentially what we call as physical assets, where the households could be going on to build on more assets, either in the form of investment in real estate or taking on more bullion in their asset book. Now here, interestingly, what we have seen, again, we do not have official data yet, but anecdotal evidence does point us to the direction that physical assets, that is investment in real estate, has gone up fairly well in the last 1 to 2 years. And so in some sense, the rise that we have seen in financial liabilities, the debt that the households have acquired, could in part also be besides financing some part of the current consumption, could also be getting directed towards financial physical assets and investment in real estates. So that to me is not a very it's a good sign, if you ask me, because they are taking on more debt to build an asset, and their expectations of incomes could be very well be in the positive direction, that they are positive that they'll be able to pay back this debt over a longer period of time.
All right, very interesting. Professor Arun Kumar, good to have you back, sir. Do you agree with that analogy? Some of this debt could be towards physical assets, which is not a part of the report. There's not a lot of data to suggest how much people are buying real estate, for one example, to what extent are they buying, and that is in itself an investment, because we don't have much data to attest to that. Therefore, the burden or the financial liability is not a problem, at least in the interim.
I think we have to be a little careful in our analysis, because typically consumption plus saving plus external sector plus government should add up to 100%. Now, if consumption share in the GDP has fallen, then other components should rise. So why savings rate as a whole has fallen, that is a cause of concern. Second is, the savings rate is a share of savings over the GDP. Now, if our GDP is not correctly measured, then our savings rate would also not turn out to be correct. The third point that I want to make is that, we must distinguish between the different categories of people. They're the rich, the middle class, and the poor. Now, as far as the poor are concerned, they save very little. So when we are talking about the savings propensity of the economy, we are talking about what the well-off segments of the economy are doing. So this household financial savings data pertains to about 6 or 10% of the population of the country. Now, what is happening with them? There is the middle class. Middle class perhaps has been hit by inflation and unemployment, and therefore they need more funds to sustain their consumption, and they could be borrowing unsecured loans for that purpose. So that is also something that we need to look at. It's the well-off segments which will be buying more of real estate and more investing in the share market and so on. Their financial savings in the form of shares, etc., could go up, which is what the data seems to suggest. Their buying of physical assets based on loans, that could be going up, and therefore the borrowing could be going up. So I think we need to take a disaggregated look at the entire picture before we can understand it.
Okay, disaggregated look. That's a interesting, important understanding of how the current data and what sort of picture it presents. Before I go back to Yuvika, there are two sides to this story, as we have come to understand at this point. One is, of course, the fact that people are buying more physical assets, so the money could be going towards that, and hence the liabilities, at least in the interim, is rising. Debt is at an all-time high, about 40% to a household in India. The other side is, of course, the savings side of it, which is also going down substantially. How do you really find the balance between these two very different and contrasting data sets?
Right. So, Shweta, savings would come down only if the money that's going to service your debt is going up. So what do I mean? If larger part of your income is being spent on servicing the debt, only in that scenario will your savings really come down, because then reduces the disposable income that you have. So I think that's one key thing, which is why I was talking about the debt servicing ratio. So more than just the aggregate debt numbers that we're talking about, I think it's more important to look at the debt servicing ratio of Indian households, because that is where we see a sharp increase that it's happening. So in India's case, I think there are two factors which have which are behind this higher debt servicing ratio. One is, of course, the higher rate of interest. Okay, and second is the lower tenure of these loans. So what it means is that if my interest rate is higher, I'm paying more for every 100 rupees that I borrow, and if my tenure is shorter, then the compounding effect of that is even bigger.
Okay.
So a larger part of my income is going to servicing the debt compared to, let's say, other nations, even highly indebted nations, let's say in the Nordic countries. So that is one reason. So if in India, for example, if the interest rates were to come down, or if people were able to access longer term, debt loans, then you would see that the debt servicing ratio comes down, and that would then not be of that bigger concern, because the absolute number per se does not make any, it is not of concern as such.
Okay.
It is the debt servicing ratio, to my mind, which actually is more important.
All right. So, Yuvika, something very interesting that the two gentlemen on the show have pointed out to us. One, of course, is the fact that debt servicing ratio is an important aspect to discuss when we talk about debt. The other part, of course, is the savings part of it, which Professor Arun Kumar alluded to, that it's not, it's the people who are unbanked, people who have not traditionally saved, who are also seeking out loans to meet their daily expenses. And every time we talk about savings, one has to understand that there are a certain category of people who may be able to afford that big bulky asset in form of a house and take loan for that, but majority may be still struggling to even afford 2 square meal a day. In your assessment of the data that has come out, what sort of picture does it present to you? Is it a picture where India or Indians rather need to be worried about how much loan they are taking on their books, or is it fairly plausible, and when compared to other developing economies around the world, data does not look that bad after all?
So Shweta, let me answer this in a two-pronged way. One, we do not have enough data. So data that we have is only up till FY23. And most of our assessment for FY24 is based on anecdotal evidence. Now, remember that since FY21, the 2 years between 21 and 23 were COVID years. And there is a possibility that the trends that we are seeing could be largely driven by COVID, because as we know, the economy came to a standstill. Incomes did take a hit, more so at the lower end of the income pyramid. So there is a possibility that households did take on more debt to finance current consumption. There is also a possibility that households did take on more debt to finance pent-up demand that was created during the pandemic. There could be a variety of reasons. Like I said, there could be debt-fueled acquisition of physical assets also that we are seeing. So in totality, we still do not have a grip over what induced which parameter and how things have moved, because we do not have a granular assessment of data so far, not just for FY23, but not for FY24. So most of these understandings or underpinnings that we are talking about are largely based on macroeconomic dynamics or our own juxtaposition or positioning of what we saw up till FY23 and thereafter. Okay. Now, we also have to keep in mind, while we talk about income levels, but what about demographics? We have a young population which might not be wanting to save at the same pace that we did probably when we were in our early 20s and 30s. So not just COVID as an external or an exogenous factor, but even how demographics could change the savings pattern in the country is something that we do not talk about much. So we need to be a little bit more patient, I think, need to get more granularity in data and to be able to assess and probably chaff the grain from, the noise, and probably then take a call as to whether it looks to be a more structural change in the savings behavior, or is it something that was induced by COVID and could probably see some bit of normalization in the years thereafter.
Okay,
so I think it's too premature to be able to draw a concrete conclusion as to what is happening in the economy basis just 1 or 2 years of data that from the pandemic years.
Absolutely. Extremely interesting. In fact, we were discussing this in the newsroom right before we came in. What exactly is happening? Trying to understand, have people changed? Have demographies changed? And our behaviors towards savings changed? And come to think of it, a lot of us today aspire to buy a lot more than our parents did. We spend a lot more than our parents did. We want to go abroad. We want to, invest in a car, in a phone, and which are way more expensive True. As compared to previous generation. Professor Arun Kumar, before I close the show, sir, would you agree that perhaps we need to still wait and be patient before more data comes out and before we come out with a concrete sort of understanding of what's really happening here, whether savings are actually going down or this could just be a post-COVID effect, and of course a change in demography and their needs and their consumption and expenditure patterns?
So you have several questions in there. The first point is that the economy has received several shocks, whether it be demonetization or GST or NBFC crisis or then the pandemic and the corona. And each time the shock was there, the GDP fell, and that therefore has its own impact on the savings, because where the fall of the GDP was in the unorganized sector, not in the organized sector. So in effect, if the GDP had not been rising as much as was given officially, then of course what you'll have is the savings rate dropping. because the savings rate is being divided by a larger GDP than actual. So that would be one kind of a thing. The second is when you say that a lot of young people are buying cars, etc., you're only talking about the organized sector, the 6% of the workforce, and maybe about 7 or 8% of the total people in the economy. The rest don't buy cars, they don't go out for vacations the way, the 6 or 7% go. So in other words, when we talk about the consumption of, durable goods and holidays and so on, we are talking only about a small percentage of the economy. So therefore, we have to be very clear about whose saving we are talking about and what is the GDP that we are talking about. Then only will we be able to decide about whether the savings rate, and especially here you're talking about the financial savings. The financial savings, of course, apply only to the top 5 or 10%, not to the bottom 90%, because they have very little financial savings. Whatever they have, they either consume or they put into some kind of physical asset with very little actual financial saving. So these are some of the factors that we'll have to take into account if we are to come to any definitive conclusion.
Absolutely. Always good to have you on the show, Professor Kumar. Yuvika, thank you very much for joining in. It's a diversity of opinion there,
yes.
Shri. But
one fact, which is undeniable, Shweta, is that, as your grandmother would tell you, it's very important for everyone to save.
Absolutely.
Not just for a rainy day, but even for a country, because if people don't have savings, the country cannot fund its own growth.
Absolutely.
It's as simple as that.
And that takes a hit on India's fiscal deficit, of course. And that, of course, is another story for another day. But for now, remember, it looks like household debt is on the rise, but may not be a cause of worry just as yet. We will have to, of course, wait for similar such data patterns to emerge in the near future.